ways for investors to participate in an IPO-3 buying after listing secondary market. If an investor fails to get an allocation through public subscription or misses out on dark pool trading, they can still buy the shares in the secondary market once the company is listed. The secondary market offers greater flexibility, as investors can enter or exit their positions at any time during trading hours. However, new stocks often experience high volatility in the first months of listing. This volatility can be attributed to several factors. Firstly, there is often a lot of speculative trading in the early days as investors react to the initial performance of the stock. Secondly, the lockup periods for certain shareholders, such as pre-IPO investors and company insiders, may not have expired yet. When these lockup periods end, a large number of shares may flood the market, causing the price to drop. For example, if a company's pre-IPO investors are allowed to sell their shares 3 months after listing, the increased supply could lead to a decline in the stock price if there is not enough demand to absorb the shares. Another factor contributing to post-listing volatility is the release of new information. Once a company is public, it is required to disclose financial results, business updates, and other material information on a regular basis. Any negative news, such as lower than expected earnings or regulatory issues, can cause the stock price to plummet. Conversely, positive news can lead to a surge in the price. For instance, a newly listed technology company that announces a major partnership with a leading industry player may see its stock price rise significantly in the days following the announcement. Investors who choose to buy in the secondary market should closely monitor the trading volume. A sudden increase in trading volume can indicate a shift in market sentiment. High volume on a price increase suggests strong buying interest, while high volume on a price decrease may signal selling pressure. Additionally, technical analysis can be a useful tool. By studying price charts and indicators such as moving averages and relative strength index (RSI), investors can identify potential trends and make more informed trading decisions. It is also important to consider the company's fundamentals when buying in the secondary market, even if a stock is performing well in the short term. A lack of solid fundamentals, such as high debt levels or declining profit margins, can lead to poor long-term performance. Investors should review the company's prospectus, annual reports, and analyst reports to assess its financial health and growth prospects. In addition to the 3 main methods, there are other factors that investors should take into account when participating in IPOs. One such factor is the reputation and track record of the underwriters. Underwriters play a crucial role in the IPO process, from setting the offering price to marketing the shares. A reputable underwriter with a history of successful IPOs is more likely to price the shares fairly and ensure a smooth listing process.